Good morning. I'm Gary DeWaal, and this is Bridging the Week for June 19th to 23rd, and today is June 26, 2017. The Office of Inspector General of the Commodity Futures Trading Commission severely criticized the agency's cost-benefit analysis relied on in promulgating the Commission's final rule for margin for uncleared swaps issued in December 2015. Additionally, in a rare current disciplinary action involving pit trading, 5 respondents settled disciplinary actions brought by the Commodity Mercantile Exchange, alleging that they engaged in prohibited conduct to avoid payment of fines mandated when members of a broker association trade opposite each other in restricted contracts for more than a designated maximum percentage of their overall volume. I'm off for vacation for a few days later this week, so I can catch my flight on time. Let's get started. The Office of Inspector General of the Commodity Futures Trading Commission said that the agency, quote, lacks an institutional commitment to robust cost-benefit consideration, end of quote, in roundly criticizing the Commission's analysis of the potential costs and benefits of its final margin rule for over-the-counter swaps issued in December 2015. The office claimed that, although, as a general proposition, the CFTC claimed that the final rule would, quote, reduce systemic risk, end of quote, it never evaluated this claim against, quote, unintended consequences that might undercut the asserted systemic risk mitigating effects of margin or increase the burdens on market participants, end of quote. Among specific factors the CFTC did not consider, claimed the office, was the impact of the rule on possibly reducing market liquidity and diminishing efficient risk hedging by certain market users, the pro-cyclical impact of margin requirements to heighten systemic risk during a time of market stress, and the increase in systemic risk that might occur because of, quote, an industry-wide homogeneous approach towards risk modeling in consequence to the margin rule's initial margin modeling specification, end of quote. In part, claimed the office, the CFTC's deficiency in adequately considering costs and benefits were attributable to its quote-unquote inadequate data infrastructure. The Office of Inspector General called on the Commission to prepare more quote-unquote economically rigorous cost-benefit analyses going forward. In a rare current disciplinary action involving floor trading, the Chicago Mercantile Exchange brought and settled disciplinary actions against 5 individuals associated with the same broker association, 4 of whom were allegedly trading customer orders opposite each other without complying with strict exchange rules that permit such trading with severe restrictions. According to a CME Business Conduct Committee panel, on numerous occasions between September 2015 and December 2016, 4 members of a single broker association traded customer orders opposite other members of the same association that were improperly verified as being, at the time, the best and only bid and offer. This apparently was done to avoid percentage limitations members of the same broker associations may trade opposite each other without being subject to mandatory fines for such conduct. The Business Conduct Committee charged that one runner and trade checker for the association, John Calarco, was responsible for improperly documenting customer orders to conform to the exchange requirements, and on one or more occasions, along with another non-member employee, endorsed and submitted trading documents to market regulation with witness signatures that, quote, the purported witness did not endorse himself, end of quote. For this, John Calarco agreed to pay a fine of $10,000 and be suspended from access to all CME trading venues for 2 years. That's all CME group trading venues for 2 years. In addition, Frank Calarco and Philip Mansfield, principals of the association, agreed to pay fines of $47,500 and $77,500 respectively. Each was charged with failure to supervise their association's member and non-member employees. Finally, Andrew Schweitzers and Joseph Cosenza, other members of the association, agreed to pay fines of $10,000 and $15,000 respectively for their alleged role in this matter, and to serve trading suspensions of 5 business days and 20 business days respectively. Separately, Arlington Commodities agreed to pay a fine of $10,000 for entering into a block trade when it allegedly was not an eligible contract participant as required. Additionally, EDF Man Capital Markets consented to pay $100,000 for purportedly not conducting adequate due diligence to ensure that one of its customers that executed a block trade was an ECP. EDF Man also agreed to implement procedures to verify that its customers are ECPs before permitting them to engage in block trades. And finally, Wells Fargo Securities agreed to pay a fine of $3.25 million to resolve administrative charges brought by the Financial Industry Regulatory Authority that from January 2008 through March 2017, the firm failed to have, quote-unquote, any system of supervision to ensure its compliance with its position reporting obligations for over-the-counter options transactions. According to FINRA, after Wells Fargo, formerly known as Wachovia Capital Markets LLC, executed a large over-the-counter options trade in 2008, the firm recognized its need to develop systems to report OTC options trades. However, said FINRA, because of various business combinations in fall 2008, the firm never implemented this project until Wells Fargo Security became self-clearing in mid-2014. However, even after developing a system to ensure compliance with reporting obligations, Wells Fargo Securities continued to have reporting problems with its OTC option trades through March 2017, said FINRA. Well, that's it for this week's edition of Bridging the Week. As always, there is more information in each article and more articles on the article version of Bridging the Week on the website. Check it out. I'm Gary DeWaal. Have a great week, and until the next edition of Bridging the Week in 2 weeks, ciao.